Good evening, everyone. Time for another silver update. You're looking at the live streaming quote list from netdania.com, and I'll include the link below. Thanks to NetDania for letting me use their charts. Now, why I have this on the beginning page is I want you to look at the returns that we have for the year so far. These are year-to-date percentage changes, and we've got a good 6.3% for oil and about 13.8% for silver, which is pretty good return for a year, and of course gold is at 26%. The rest of these are just down a couple or up a couple. So these are your big winners for the year. Again, if you remember, I pointed out last year in December that silver had returned around 85% for the year. So a fantastic return year after year after year. And that's going to be the main topic I'm going to be addressing tonight. Now, first of all, let's look at the chart of silver. We're still trying to rally with this MACD and try to turn it around. We still have that very sharp bounce, and on the daily we may at some point actually approach some type of possibly intermediate overbought price, but we're above 35 and we're rising. For those of you who took my advice and got in on this spike low, I know it was very short-lived, so it was difficult to predict. If you remember, the Friday before this happened, I posted my video about loading the boat, and I told you that weekend was the weekend to buy. So hopefully a lot of you added a lot of physical silver on that weekend. I don't think you're going to see those prices again. Now, let's look at the Japanese yen real quick here, because we're fading off of this intervention that was the Bank of Japan. I think we have to go to the 30-minute to grab it now. And so you can see we had that violent intervention by the Bank of Japan, in my opinion, encouraged by the Federal Reserve to prop up the dollar. It's now given back about almost 50% of the rally. So we're going to see, we probably can see by the volume, this is typical that you'll see it drift down, and they'll test to see if anyone's going to come in and oppose them. You can see that we got below this support line, so we managed to test down to here. And if we line up right where we had there, you can see there was a little bit of defense that came in right about there. So they're probably going to let this thing drift back down to new lows. That's been the pattern for a long time. And you can see the Fukushima intervention was actually much more violent. And ultimately, it actually made new lows below that. So again, Jimmy Rogers' advice against central bank intervention is wait for the rally and go the other way. So with that, I wanted to go to the main topic tonight, and that is pension Ponzi schemes. And this is another article that is by Charles Hugh Smith, and he's from of Two Minds, and it's on Zero Hedge, and it's something that's been bouncing around in my mind a lot lately. Of course, today is an election day in many of the states, and in some of the states you have referenda on some of the various issues. In Ohio, there's an issue regarding the right of collective bargaining for government workers, and that's a very heated battle. And there are other ballot measures in different states. So we're starting to see this austerity squeeze regarding these pension plans, and I'm going to talk about that and talk about the ideas behind that. But first I want to read a little bit of this article. He says, next in line for implosion, pension plans. Pension plans are based on 8% annual growth forever. What happens to these plans in a zero interest rate world as the global economy and stock markets contract? I'm afraid it's time for an intervention. I don't enjoy being the bearer of difficult news, but now that Europe has stumbled drunkenly into the pool and has been rescued, it's once again tearfully blubbering that this time it's all going to change, and a new prime minister in each dysfunctional, insolvent EU nation is going to make the pain and the addiction all go away. It's time we face the reality that Europe and the US are in full-blown financial alcoholics, addicted to illusion and debt. And what do they turn to as solutions? The very sources of their pain, illusory fixes and more debt. Have you ever seen a global market as dependent on rumors of magical fixes for its resilience as this one? What is truly remarkable is the psychotic distance between the facts. Europe's debts are impossible to service. Its economy is free-falling into recession. The U.S. is already in recession. China's real estate bubble has popped and cannot be reinflated. And the heady leap of global markets on every trivial rumor of a magic fix. Since it runs in our family, I do not use the word alcoholic lightly. Those of you who have dealt with alcoholics know the drill. The liquor stashed behind the fridge, as if everyone doesn't know it's there, the stumbling into the pool, the humiliating rescue, the tearful promise of change which goes nowhere, and all the rest. I seriously suspect the entire global economy is alcoholic. Not about liquor, but about debt, and the impossibility of paying entitlements which expand by 8% a year in an economy which grows by 2% a year at best. In all the millions of words printed about the subprime meltdown, the gutting of the U.S. financial and housing markets, and now about Europe's impossible burden of debt, how often have we seen anyone in the mainstream media or mainstream financial press confess that borrowing our way out of trouble is not just financially bankrupt, but morally bankrupt as well? Like a full-blown alcoholic, the people and governments of the U.S. and Europe stagger from debt source to debt source, weaving drunkenly between stashes of new debt in the Fed, Treasury, and private sector markets. Despite the abject failure of the magical thinking fix of becoming solvent by exponentially expanding debt, we see the same pathetic pattern repeating in Europe, where the apologists for the alcoholic debt binge continue to claim the risk of systemic failure and collapse of asset values is low. While everyone is focused on the drunk being pulled from the pool, Europe's sovereign debt, another drunk, is teetering on the edge. Public and private pension plans. Here's the reality in a nutshell. Pension plans only work if they earn average returns of around 8% per year, basically forever. Gripped by the monomaniacal desperation of an addict who seeks no other path but another hit, central banks have lowered interest rates to near zero to quote-unquote spark growth. Unfortunately, the only thing being goosed is the future cost of servicing the additional debt. How do you earn 8% on money which yields at best 3%? You can't. How do you reap a gain on bonds when interest rates have already hit bottom and they can't fall any lower? You can't. Which leaves the stock market. And he goes on. I'm not going to finish reading the rest of it, but you can see as he's pointing out that they have really assumed an unrealistic return, and they're not actually returning that return, and they're lying about that. And that's where I wanted to go next. I want to, before I look at the issue, the main issue tonight, I wanted to look at the definition of a Ponzi scheme. It's very important that we understand the investment of a Ponzi scheme, the definition of a Ponzi scheme, because when we start to look at some of these things that the governments are doing, we really have to ask ourselves, are these Ponzi schemes or are these not Ponzi schemes? And what is the real definition of a Ponzi scheme? So let's read this real quick. This is a Wikipedia entry on Ponzi scheme. A Ponzi scheme is a fraudulent investment operation that pays returns to its investors from their own money or the money paid by subsequent investors, rather than from an actual profit earned by the individual or organization running the operation. The Ponzi scheme usually entices new investors by offering higher returns than other investments in the form of short-term returns that are either abnormally high or unusually consistent. Perpetuation of high returns requires an ever-increasing flow of money from new investors to keep the scheme going. Now, the reason I'm reading this definition is because if you remember, the percentage that is continually cited by Charles Hugh Smith is 8%. Now, if you remember when the Madoff scheme unraveled, that was actually a figure that was cited. Now, it seems to have gone into the memory hole, and I can't find articles citing the 8%, but I did find an article citing 10 to 12%. So we'll read from that, and it's very interesting. It is a New York Times article, and it's called "The Rules That Madoff Investors Ignored." Now, this is very interesting because in the Madoff case, there were a tremendous number of clawback provisions that were enacted by the courts where they actually went after the people who made money off of Madoff and took the money back. So let's look at how they determine whether these people should have known. And in fact, the courts have used language that implies that they should have known by the return. So let's read a little bit about this. Bernard Madoff, the Cheshire Cat of financial swindlers, did what advisors to the very rich only dream about. He persuaded them to hand over a huge percentage of their net worth with less due diligence than they would do before purchasing a launch for their yacht. And he goes into this. Now, he's talking about some of the returns. Here he talks about the 20% return every year for 30 years. Okay, so he's saying that delivering 20% for 30 years would have been too hard to believe. In other words, that's too high. Anybody who delivered 20% for 30 years obviously is a crook. And payout, well, 5% would have sent most people searching for more elsewhere. Returning 10 to 12% per year, year after year, was a stroke of genius. It was within the realm of possibility, if just barely. Now, this is the key. So let's go back to our pension funds. Remember, they're assuming an 8% return year after year after year. And yet the courts are telling us that Madoff returning 10 to 12% year after year after year should have been a red flag, and they should have known that that was a Ponzi scheme. Is this a Ponzi scheme? That's the question. Now, if we look at these pension plans that the various governments are running, whether they be the local governments, the municipal, the county, the state, all these various governments, they all have their own pension plans, and I've covered the CAFR before. But the question is, are these pension funds really returning 8% year after year after year after year? Or are they paying out benefits based on the assumption that they will get those returns year after year after year, but they really aren't earning those returns? And if that's the case, if they really aren't earning 8% year after year after year, then doesn't that mean that they actually are paying out the returns to the pensioners out of the current investors? And if that's the case, that they have an abnormally high return year after year, and they're paying the previous investors out of the current investors, aren't they really a Ponzi scheme? Doesn't that mean that the municipal and state and county and even federal pension funds are really just Ponzi schemes? Isn't Social Security, isn't that a Ponzi scheme by these definitions? So now, I'm not saying that I buy this, because actually I don't buy this. And the last thing I want to leave you with is I'm going to bring up the dreaded calculator. And if you remember, one of my heroes is Jimmy Rogers. And if you've read Market Wizards, the first book, and subsequent interviews with Jimmy Rogers, you'll know that he started Quantum Fund with George Soros. I believe he gave the figure, there's a figure sticking in my mind, I think it was $675 was the figure that Rogers gave as the figure that he started with, which seems absolutely unbelievable. But I've talked to a lot of investors, a lot of traders, and the types of returns that Rogers reported, and there's a lot of other people. I highly recommend that you read that book, Market Wizards. I'll go ahead and put a link below to that book so you can check it out on Amazon. But there's a lot of hedge fund managers, Paul Tudor Jones and others, that returned year after year after year large returns. So that in and of itself is a violation of this Ponzi principle. It actually is possible for a very talented investor to return that year after year after year. Now, I think Rogers retired in the late 80s or early 90s, but we're just going to, for the sake of an example, we're going to take his amount. So we're going to take $675, and this actually was a fairly common return for some of the hedge fund guys that were in Market Wizards. And we're going to do 60%. So we're going to do 675 times 1.6, and that's a 60% return. I'm sorry, I got that wrong. So we'll do 675 times 1.6. Okay, and we're going to do this for 30 years. So that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24, 25, 26, 27, 28, 29, 30. So that's $1 billion. If you started with $675 and returned 60% for 30 years in a row, you would have roughly $1 billion. Now, of course, Rogers and Soros had new money coming in. Anybody who runs a hedge fund who is returning 60% year after year after year after year is going to attract new funds. And a lot of these hedge funds actually had to close down to new funds. They had plenty of money. The problem was that their strategies were too profitable for the size of the markets they were in, so they actually had to close to new investors. So the reason why I'm bringing this up is it actually proves that the whole Ponzi scheme argument is bogus in the first place. But if these judges are going to make the argument that the investors should have known by the returns that they were receiving that they had been invested in a Ponzi scheme, then shouldn't these investors in government pension plans know that if they're promised an 8% annual return forever, that they're involved in a Ponzi scheme? And if that's the case, then where does the clawback come from? So those are very interesting questions, and I think they're very timely because this is all going to come to a head soon. And it's obviously very ironic that the one investment that has returned stunning percentages year after year after year, of course, is gold and silver. So these investments have actually defied the rules of the Ponzi system, and they have proven that you can return high percentages. We've returned high percentages really since about the summer of 2003. So we're now 8 years running returning at least double-digit returns, and in some cases nearly triple-digit returns. And I think for the next 5 to 10 years, silver is probably going to return at least double-digit and possibly triple-digit returns. And we'll talk to you next time.